Hey guys, it's Nick here from Nick's Finance Tricks. Thanks for tuning into my channel. Today we're going to go over my first spreadsheet, which is a stock valuation spreadsheet. It employs the dividend discount model, the capital asset pricing model, and it also calculates the stock's beta. If you haven't already downloaded this spreadsheet, you can head to my page at the address below and download via the post that way. Okay, let's make a start. So this is the blank template that you should be looking at. Let's quickly go through the pages, sheets. So we'll run through an example. Today I've selected Transurban to review. So I'll just type in ticker symbol up the top there. And I've got automatic calculations turned off, so just hit Shift F9. That'll bring up all this information. And so the comparative index is what we use to measure the stock's performance against for CAPM. So we're just going to use the ASX 200. Symbol for that is hat, AXJO, enter. Okay, then we're just going to download some useful data from Yahoo Finance. Okay, so yeah, you might find these useful. This one in particular, previous close. So we'll use that when we've come up with a value, an intrinsic value for the stock. We'll compare it with this and see whether it's worth buying. We'll also now download the bond yields, which we're getting from Bloomberg. So we'll run through all the VBA code briefly in a moment. That's just coming from Bloomberg. So we've got 2-year bond yield is 1.73%, 5-year is 2.27%, and so on. Download the current interest rate, which is from the RBA website, I believe. We can have a look at that in a moment. And we'll also get the inflation rate. There we go. And then, current as of 2nd of November and September 17. We'll also update the ASX list. Should get a little update down the bottom here. There we go. So all that did was update these 3 columns, and just when you want to analyze a new stock, you might just want to update that in case it's a new stock and it's not listed. It wasn't listed previously. Okay, so now we go to price, and here is where we'll download the historical price for Transurban. This is all coming from the Yahoo Finance website. Okay, we've got to update the status bar down the bottom here. It's pretty fast. Then we'll go to sector. So this is just the GICS industry sector. So for us, for Transurban, it is the industry group, sorry. So it's transportation. So we'll download the index for transportation from Yahoo Finance website also. And then the market, which is proxy for the ASX 200. We'll download that. Okay, so now we have all the data we need. We can go to our first CAPM model and start crunching some numbers. So first drop down box here is investment horizon. So I would normally have this on 15 years just because I plan on investing for a long time. So that just sort of dictates what risk-free rate we'll be using. So because we're using bond yields, we've either got the options of 2, 5, 10 or 15. So for an investment horizon of more than 15 years, you'll just use 15. For between 5 to 10, you'll probably want to use the 10-year bond yield, and so on. Okay, now we're going to download some monthly holding period return statistics. So we'll start here with the ASX 200. So that's just going to perform a few calculations. We'll have a look at those calculations when we check out the VBA code shortly. But this is a little bit slower than normal because I'm running the screen capture. but it should be faster on your machine. Okay, so monthly holding period return statistics. So we've got the standard deviation of, while I'm here I should hit Shift F9, and that just brings up our ticker symbol. So we've got the standard deviation of Transurban's returns, monthly returns for its entire existence, and then we've got the standard deviation of the ASX 200's monthly returns, and this is the variance of the same. This is the covariance between Transurban's monthly returns and the ASX 200's monthly returns. This is the correlation between those monthly returns. This is the systematic risk, or beta. Here we've got expected values, which in this instance is just the average monthly returns. And then here we've got cost of equity. So this value is what an investor would require to invest in this company for 1 month, given the company's systematic risk. For a more detailed explanation, just have a look at this explanation here. That should clear things up. Okay, and now we can either manually go through and update all of these individually, or we can just click update all. I'm going to click update all, and then I'm going to pause the video for a moment because this might take a little while. Okay, so that took 5 minutes, a bit less, and now we've got sample statistics for all holding period returns that I've addressed here. So we've got daily holding period returns, we've got weekly holding period returns, monthly holding period returns, and yearly. And we've got that for both the market, the ASX 200, and the sector, or the transportation industry. So now we'll input these values to continue the calculation. So return on equity. So I just get these figures from Morningstar Data Analysis, but you can find them on any investing websites. So I've just used a 3-year average. You can use whatever you like. So ROE I've got as 4.68%. The dividend payout ratio I have at 85.01%. The previous year dividends per share I have at 41 cents. And then the growth rate is automatically calculated there when you press Shift F9, 0.7%. Okay, and what we're seeing down here is the risk-free rates for the 4 different time horizons, modified for the different holding period returns we address here. Then further down we've got the annualized expected returns. So for Transurban, when it's compared with the market horizon, so the amount of time the market's been around for, the ASX 200, we would expect Transurban to return 14.1% per annum based on daily sample statistics, or daily holding period returns, and then comparably for weekly, and so on. This is just the annualized cost of equity. So we'll, for example, we'll choose the market again. So we've just annualized this term here by the amount of trading days per year, which is typically 365.25 times 5/7, 5 days per week, and then minus your nine holidays per year. So we've just annualized that, and then similar for the rest. So this is the dividend discount model here. This is based only on market data, not sector data. Typically, you may have already noticed that the market data is more accurate because it's ASX 200's been around longer than the transportation industry industry sector. So we're just going to use market data here. So the intrinsic value without any growth, so without expecting any growth of the company, so it's a more conservative estimate, and you would expect, based on daily compounding, so daily holding period returns, you would expect the company to be worth $9.55 at the moment. And then based on weekly compounding or weekly holding period returns, $9.83 and so forth. So you would expect these, you would hope these to be similar. So we're seeing some pretty good results there. When you get to yearly compounding, because I don't believe it's quite as accurate, it's a little bit off. And so here we've got constant growth. So we assume the Transurban is going to grow at this rate, 0.7% per annum. So we would value the stock at $11.40 or $11.81. And comparing these figures to Transurban's current price, we see that it's currently priced accurately, or it's not underpriced and it's not overpriced according to our model here. So that's interesting. I should note here as well, if you weren't already aware, that the dividend discount model assumes you'll be holding the stock forever. So this is just quite a simple formula, and it's based on the previous year's dividends and the cost of equity. So that is one way in which we can value the Transurban shares. Right up here is another way that I value them. I like to value them in as many different ways as possible and compare the results, so it's a good way to check. So here we were just basically projecting the previous year's dividends forward based on the growth rate, so up to 40 years. So we would expect, for this, if this growth rate holds for the next 40 years, we would expect Transurban to be paying 54 cents per annum in dividends. So next we just need to calculate the present value, or PV, of all the expected future cash flows or expected future dividend payments. So we do that for all our four holding periods. So we've got daily, weekly, monthly, yearly. So this is discounted using our cost of equity from calculated here. So we just perform that calculation for 1 to 40 years. And then to get the intrinsic value, we sum the present value of those future expected cash flows. So here, for example, if we plan to hold Transurban for 13 years, we can expect to get $4.18 out of that, out of each share with this model using daily holding period return statistics. And similar for weekly, monthly, and yearly. So yes, if we plan on holding the share for the company for 40 years, we would expect almost $9, which is comparable to our estimates down here, which is good. These 40 years obviously not quite infinity, so we would expect these estimates to be less than these. Okay, so we'll move on to our second CAPM model. We'll just hit Shift F9 here. Yeah, just a few changes there. Okay, so we'll basically calculate the statistics for the Transurban with this button. So again, we'll run through the VBA coding behind all this shortly. This sometimes happens. It's a little bit annoying. It's still, the calculations are still performing. There we go. It's just the status bar freezes. Okay, we'll do the same for market. Yep. Might pause that for a second. Okay, and the same for sector, which should be quite brief. Okay, so basically what's going on here is just, this is for the market, for the ASX 200, this is the historic yearly return for 2016 financial year based on daily compounding. So that's basically compounding every trading day of 2016's financial year to calculate this average, essentially. And it's the same for weekly, except it's each week, and monthly. So I'll just hit Shift F9 again. And then we've got our statistics up here, and we've also got our intrinsic value estimates here. which again are comparable to the values we've seen on the previous page using the previous model. So I'll just mention what the main difference is between this CAPM model and the previous one we looked at. This one essentially, well, this one only compares yearly statistics, so our correlation is basically, it uses the Excel function, and that's just a little bit of that's just how the formula works. But it compares, for instance, the daily returns of the market with the yearly returns with daily compounding of the market with the yearly returns with daily compounding of the stock. So it's just comparing, ultimately it's comparing how the yearly returns of the stock and the market compare, or how they vary together. And basically the yearly returns are composed of either daily compounding, which in my opinion is the most accurate, it includes the most data points, or weekly holding period returns, which is still quite accurate. You've got like 52 data points there. Monthly, still quite accurate, but only 12 data points. Another note I should make here is that the cost of equity is calculated based on the average market return, as opposed to the expected value here, which is calculated based on compounding all these years' returns and then raising that to the power of 1 on 20. I've used the average. If you want to use the expected value, that's quite an easy change. Just like this. Enter, Shift F9. And the value is quite similar. That's user preference. Well, I might stop this video here just because we're already up to 20 minutes. I'll upload a separate video where I run through the VBA coding in the background. Okay, thanks for listening, guys.